Good morning, everyone, and welcome to the Australian Accounting Standards Board staff webcast on the recently issued WSB exposure drafts ED 334 and ED 335. These exposure drafts set out the board's proposals to require more not-for-profit entities to prepare general-purpose financial statements and its proposals for simpler Tier 3 GPFS requirements. Your presenters today are Senior Project Manager Maggie Mann and myself, Freddie Hausa. This webcast will run for around 1.5 hours or so. As usual, please observe the disclaimer. This presentation provides personal views of the presenters and does not necessarily represent the views of the board or other WSB staff. To give you a brief background to the board's project resulting in these exposure drafts, the WSB has been considering the effectiveness of the reporting entity concept in Australia for quite some time. This concept allows entities to self-assess whether they should prepare general-purpose or special-purpose financial statements, depending on the existence of the users relying on those financial statements. Concerns arose that the concept was not applied as originally intended, and more entities than anticipated were choosing to prepare special-purpose financial statements. Also, in 2018, the International Accounting Standards Board issued a revised conceptual framework that used the reporting entity term differently to describe the entity preparing general-purpose financial reports, potentially causing confusion in Australia. To address this, the board decided to remove the Australian definition and revise the application of accounting standards. Following the feedback received on the invitation to comment ITC 39 issued in 2018, the WSB has adopted a phased approach, first addressing for-profit entities in 2019 and 2020, culminating with WSB 2020-2, removing ability to prepare special-purpose financial statements for certain for-profit private sector entities, and WSB 1060, providing further simplified disclosures. There are more smaller not-for-profit entities that are required to prepare financial reports compared to for-profit private sector entities. And so the answer whether there is a need for a simpler form of general-purpose financial statements, once more entities are required to prepare GPFS, might differ for for-profit and not-for-profit entities. Also, the phased approach gave the WSB more time to consider the suitability of the ISB's conceptual framework for not-for-profit entities, while ensuring that for-profit entities could continue to assert compliance with IFRS standards. So, as a significant milestone of the not-for-profit phase of the project, the two exposure drafts, again ED 334 and 335, were issued in October 2024, proposing revisions to the financial reporting framework for not-for-profit entities. The exposure drafts are open for comment until the end of February next calendar year, and whilst would result in requiring more not-for-profit entities to prepare general-purpose financial statements, the proposals also consult on simplified requirements for smaller not-for-profit private sector entities. On today's webcast, we'll be discussing the purpose of the exposure drafts, the not-for-profit entities affected by the proposals, and we'll also provide an overview of those proposals. Our time today will be mostly spent on discussing the new Tier 3 reporting requirements set out in Exposure Draft 335. This is not to say that the proposals in Exposure Draft 334, including those amendments to the conceptual framework, are not important. Quite on the contrary, they are one of the reasons why the Tier 3 proposals have been developed in the first place. We have a lot to cover today and not that much time, so let's get straight into it. Exposure Draft 334 exposes the proposals to extend the conceptual framework for financial reporting to both private sector and public sector not-for-profit entities. A not-for-profit entity is an entity whose principal objective is not the generation of profits. The term is defined in the glossary in Exposure Draft 335 and elsewhere in Australian accounting standards, for example in Appendix D of WSB 136 Impairment of Assets. Exposure Draft 334 also proposes superseding the framework for the preparation and presentation of financial statements and SEC 1, and as a result would improve the consistency and comparability of financial reports prepared in accordance with Australian accounting standards by extending the applicability of these standards to more not-for-profit entities. Because the new criteria are objective, the proposals would lead to the end of the subjective self-assessment of whether GPFS or SPFS can be prepared. In other words, ED 334 is the document that both brings for-profit private sector entities and not-for-profit entities onto the same conceptual framework platform, and also makes the proposals to require more not-for-profit entities to prepare general-purpose financial statements. The approach taken by the board in the exposure draft is consistent to the one applied in the for-profit space, and it proposes only those amendments that are necessary to achieve its project objectives. The board recognized that there are other ways of incorporating its proposals, but this approach allows stakeholders to more easily see how existing requirements will be amended for not-for-profit entities, while showing that the exposure draft does not contain proposals that will impact for-profit entities. Before we move on, I want to highlight that as a part of extending the application of the conceptual framework to not-for-profit entities, the board is proposing a number of not-for-profit modifications to the conceptual framework so that it is suitable for not-for-profit entities. As mentioned, most of our time today will be spent on talking about the Tier 3 proposals, but we will come back to these not-for-profit modifications towards the end of our webcast today. We said earlier that part of the reason for the phased approach to adopting the conceptual framework and solving the reporting entity problem, that there are a lot more smaller not-for-profit entities that are required to prepare financial reports that comply with Australian accounting standards compared to for-profit private sector entities. This is because the relevant legislation often sets a lower threshold to require not-for-profit private sector entities to prepare financial statements that comply with the requirements specified by Australian accounting standards. So, the board considered that its conclusion is to whether there is a need for a simpler form of GPFS once it requires more entities to prepare GPFS might differ for for-profit and not-for-profit entities. If you recall, we already have Tier 1 GPFS and Tier 2 GPFS simplified disclosures. In September 2022, WSB published a discussion paper on the development of a Tier 3 simpler accounting requirements, inviting comments on the board's preliminary views about the additional third reporting tier for use by not-for-profit private sector entities concurrently with superseding the SEC 1 reporting entity concept for not-for-profit private and public sector entities. Key features of this further reporting tier exposed in the discussion paper are for the reporting requirements that are simpler to understand and apply compared to existing accounting requirements. After consideration of the feedback from the discussion paper and based on the broad support from stakeholders, the board decided to proceed with the development of an exposure draft of a Tier 3 accounting standard, simplified accounting, with simplified recognition, measurement, presentation, and disclosure requirements for smaller not-for-profit private sector entities. This is the exposure draft 335. The proposed new reporting tier serves as a proportionate response for smaller entities that are required or elect to prepare GPFS, as the board recognizes that the cost-benefit point is likely to be different for smaller not-for-profit entities and users of their financial statements. However, for now, the new tier will be only available to not-for-profit private sector entities. This is because it's the scope of the board's current project under its phased approach to addressing the reporting entity concern. So when the board considered what proposals to make, it considered only not-for-profit entities, not for-profit private sector entities or public sector entities. Because it is a lower reporting tier, this new tier will going forward be the minimum standard for GPFS of not-for-profit private sector entities. Also, because it's simpler, it is likely that the implementation costs for transitioning from SPFS to GPFS will be less than if the not-for-profit entity had to prepare GPFS that complied with Tier 1 or Tier 2 Australian accounting standards. Okay, so which not-for-profit entities are actually within the scope of the proposals, and how do these two exposure drafts fit together? Well, starting at the top yellow box, exposure draft 334, which we will call the Conceptual Framework ED, proposes amendments for not-for-profit private and public sector entities that are required by legislation to prepare financial statements that comply with either Australian accounting standards or accounting standards, or are required by the constituting document or another document to prepare financial statements that comply with Australian accounting standards, or that elect to prepare general purpose financial statements. These not-for-profit entities will, going forward, fall under the umbrella of the revised conceptual framework and also be required to prepare general purpose financial statements. Some of these entities are already preparing GPFS, and unless the entity intends to change its reporting tier, the proposals in these two exposure drafts are not expected to have any significant impact to them. Those not-for-profit entities that do not meet one of these three criteria are outside the scope of Australian accounting standards. For example, a not-for-profit entity that is required by legislation to prepare financial statements that provide a true and fair view is not affected by the proposals unless the entity has elected or will elect to prepare GPFS. ED 334 proposes one carve-out, a constituting or another document date exemption. If the not-for-profit entity is only required by the constituting or another document to prepare financial statements that comply with Australian accounting standards, and that document was created and last amended before the final proposals become effective and not further amended thereafter, the entity is able to maintain its current GPFS or SPFS status quo. This scope exclusion mirrors that available to for-profit private sector entities. The board arrived at this view for the following four reasons. First, the scope exemption would not apply to medium and large registered charities, expected to be the more significant fundraising entities for which improving the standard of financial reporting would be desirable. Second, not providing a similar scope exemption could impose cost on economically insignificant not-for-profit entities, such as small registered charities and certain not-for-profit entities without ABNs that are not matched by additional benefits. Thirdly, qualifying not-for-profit private sector entities that do not fundraise might be accountable only to their owners or members. And fourth, as the board considered that there might not exist many primary users of the financial statements of a specified not-for-profit public sector entity that meets the conditions of the proposed scope exemptions, who are unable to command more information from the entity. This does not mean that the constituting date exempted entities are not affected by the board's current proposals. Rather, ED 334 formalizes that these not-for-profit entities will fall under the umbrella of the existing framework for the preparation and presentation of financial statements and SEC 1, and also proposes that any not-for-profit private sector entities falling into this category will have to comply with mandatory disclosures in any special purpose financial statements that are prepared in accordance with Australian accounting standards. So what are these mandatory disclosures in special purpose financial statements? The requirements are set out in WSB 1054 and in the main are designed to help users understand the accounting policies adopted in special purpose financial statements and the extent to which these policies differ from Tier 1 GPFS accounting policies. They mirror the disclosures specified for for-profit private sector entities. However, unlike for these for-profit private sector entities, there is a proposed opt-out if the entity has not done any work to understand the extent of alignment or difference. In ED 334, the WSB proposes to carry forward the not assessed option that is currently available to not-for-profit entities that are currently required to make similar disclosures. Alright, we have discussed all the light blue boxes. Now we start from the other yellow box. As mentioned, ED335, which we will call Tier 3 ED, makes proposals for a new reporting tier of GPFS. The proposed Tier 3 standard would apply only to Tier 3 entities. A Tier 3 entity is permitted but is not required to prepare Tier 3 general purpose financial statements. These entities can instead prepare GPFS that comply with Tier 2 reporting requirements or, if required or desired, Tier 1 reporting requirements. So what is a Tier 3 entity? A Tier 3 entity is defined as a not-for-profit private sector entity that A. doesn't have public accountability, and B. is not prohibited from applying Tier 3 reporting requirement by legislation, its constituting document, or another document. For the purposes of the accounting standards, public accountability is a defined term. The definition is in Appendix A of WSB 1053, and it's also proposed to be defined in a glossary to the Tier 3 standard. Public accountability does not have the meaning a layperson may assign to it when considering a not-for-profit entity like a charity. Rather, the Australian accounting standards state that the entity has public accountability if its debt or equity instruments are traded in a public market, or if it holds assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. For example, think about banks or credit unions. As you imagine, there are not expected to be many not-for-profit private sector entities that would have public accountability in the manner defined in Australian accounting standards, but there may be some. The second condition for an entity to be able to prepare Tier 3 GPFS is simply that it is not prohibited from doing so. One of the significant matters that the WSB considered in developing this exposure draft is whether it should define reporting thresholds, similar to how legislation may specify that entities meeting different levels of revenue and/or other targets have different extents of financial reporting obligations. The board considered that as a standard setter, its role is not to, nor does it have the ability or legislative power to develop financial reporting thresholds in Australian accounting standards. The WSB views the establishment of appropriate reporting thresholds and any application of a specific form of GPFS to be more appropriately within the remit of the relevant legislation or regulatory authority. Therefore, the board decided that Exposure Draft 335 should propose that all not-for-profit private sector entities should have access to Tier 3 reporting requirements unless they are prohibited from doing so. This is not to say that Tier 3 GPFS are appropriate for all not-for-profit private sector entities. There is a difference between a notion which entities Tier 3 applies to and a notion which entity is Tier 3 appropriate for. Remember, aim of the project is to develop a proportional response for smaller not-for-profit private sector entities. Larger entities and entities with more complex operations should consider whether compliance with Tier 3 reporting requirements would be sufficient to meet the needs of the users of its financial statements. I will now hand over to Maggie, who will start off our overview of the Tier 3 exposure draft proposals.
Thank you, Freddie, and hello everyone. We'll spend the next 60 minutes or so on the Tier 3 reporting requirements, and we hope that by the end of that time, you will have a better understanding of the proposals set out in the Tier 3 ED. Before we start on the actual requirements of proposals in the draft Tier 3 standard, I wanted to briefly comment on how the Tier 3 ED proposals were developed. So the Tier 3 ED proposals were developed having regard to a set of principles so that there was consistency in the board's decision making and also to act as a boundary for possible simplification alternatives. The principles are the same as those shared in the discussion paper that preceded this ED and are development of the reporting requirements is subject to the WSB not-for-profit standard setting framework. T3 GPFS must provide useful financial information to users of those financial statements. Consistency with T2 requirements is desirable, but may not always be warranted. The aim is to maximize leveraging information that management uses to make decisions about the entity's operations, where possible within the context of the conceptual framework and user needs and cost-benefit considerations. And finally, the cost-benefit balance is appropriate. So we want to encourage you to let us know if you agree or disagree with these principles. And if you disagree, it will be helpful to us if you could explain why you disagree with one or more of those principles. So what are the possible simplification alternatives considered by the board? So as listed on the slide, there are 7 types of simplification alternatives reflected in the board's T3 proposals. The first is the omission of uncommon requirements or topics. Now, this is where the T3 proposals do not include requirements or guidance on certain transactions, other events or conditions because they are expected to be uncommon to smaller not-for-profit private sector entities that may apply the T3 standard. The second is simplification of drafting and language. Now, this is where the T3 requirements are consistent with the T2 requirements, but they are expressed in a simpler way. The third and fourth form of simplification is presentation, recognition and measurement requirements, which is quite self-explanatory there. So this is where the T3 proposals have simplified presentation, recognition and measurement requirements compared with the T2 requirements. The fifth is that the WSB decided T3 may provide further accounting policy choices. So this is where the T3 requirements provide an accounting policy choice in addition to those contained in the T1 or T2 reporting requirements. The sixth type of simplification is, of course, overall fewer disclosures. This is where T3 requirements have fewer disclosures compared with the T2 requirements. And lastly, the board decided a form of simplification is additional disclosures supplementing simplified recognition and measurement requirements. And this is where those T3 requirements specify simplified recognition and measurement requirements compared with the T2 requirements. And in some cases, those simplifications are supplemented by additional disclosures. Now, we've also developed a document called a summary of the T3 exposure draft proposals and the extent of simplification against T2 requirements, which provides more information on the types of simplifications reflected in the T3 proposals that you may like to refer to, and that's published on our website. Now, there will be links later in the webcast where you'll be able to find that information. Most of our webcasts today will be focused on simplifications 3, 4, and 5. However, we want to encourage you to let us know if you agree or disagree with any of the simplifications applied on the topics covered in the draft T3 standard. So that's the recognition and measurement and disclosure type of simplifications, but also the way the simplifications apply to the structure of the proposed standard, for example, the use of simplified language in the draft standard. And if you disagree, it would be really helpful to us if you could explain why you disagree with the board's proposals. So talking about one of the simplifications to drafting and language, the board's view is that the T3 reporting requirements should be contained in a single standalone accounting standard rather than in a separate suite of accounting standards or as modifications to the existing Australian accounting standards. This position is consistent with its view expressed in the predecessor discussion paper and supported by feedback received to date. In the main, each section of the proposed standard is like a mini standard. So the section is set up similarly to a topic-based Australian accounting standard and consists of scope and definitions, recognition and measurement requirements, and then finally ending with disclosures. The standalone standard will contain only accounting requirements that are common to smaller not-for-profit private sector entities and express requirements in a manner that is easier to understand. For example, the proposed T3 standard describes how to estimate fair value in a simpler manner rather than the 3-level fair value hierarchy described in WSB 13 fair value measurement. Another example is using simpler language, such as using the words record rather than recognize. Now, these nuances of the draft standard may not come through in this presentation or the summary document of the proposals, so it's really important that you do read the text of the actual exposure draft itself. In determining the common requirements for smaller not-for-profit private sector entities, the board used the ACNC's revised definition of medium-sized charities, so that's annual revenue between 500,000 and less than 3 million, as a reference for developing the T3 requirements. This helped identify transactions and balances for smaller, not-for-profit private sector entities that might prepare T3 general purpose financial statements. So the board aimed to reduce compliance costs while enhancing financial statements' usefulness, guided by the established principles rather than setting a financial reporting threshold boundary. So the standalone standard will exclude certain accounting requirements that are only relevant to for-profit sector, and transactions, events, and other conditions that the board considers would not be common to when considering the size of the not-for-profit entities the board has in mind. So for example, the draft standard does not include provisions for assets held for sale or for disclosures of earnings per share or operating segments. So how should an entity treat transactions, events, or other conditions that are not specifically addressed by the draft standard, if those exist? Well, for specified events and topics, the draft T3 standard, like the ASB 1060, proposes that the entity apply accounting specified by topic-based Australian accounting standard and the disclosure requirements of ASB 1060. The specified topic relates to share-based payment arrangements, insurance contracts, assets held for sale, exploration for and evaluation of mineral resource activity, defined benefit plan obligations, biological assets and agricultural produce at the point of harvest, and complex financial instruments. Complex financial instruments are identified in Section 10, Financial Instruments, and we'll be discussing them in a little more detail later on this presentation. For everything else, the T3ED proposes that the entity be required to develop an accounting policy having regard to a specified hierarchy. The proposed hierarchy requires the entity to first consider the principles and other reporting requirements in the T3 standard dealing with similar or related issue. If those don't exist, then the entity would consider the definition, recognition criteria, and measurement concepts for assets, liabilities, income, and expenses in the Conceptual Framework to the extent that they don't conflict with the T3 standard. One of the board's consideration in developing the T3 standard is whether an entity should be able to apply an accounting policy specified by a higher reporting tier. The board received mixed feedback on whether opt-out should be freely permitted when it sought stakeholder input in this regard as part of the DP. Reflective of a tension between the usefulness and the comparability of the resulting financial statements, and having considered the feedback, the board decided to propose that an entity may opt up to an accounting policy specified by higher reporting tier only where the transaction, other event, or condition is not specifically addressed by, and that's scoped into the T3 standard. And then an entity applying the T3 reporting requirements may not apply any T1 or T2 reporting requirements that conflict with that T3 requirements. So what does that mean actually? So I'll give you an example. So an entity preparing a T3 GPFS cannot apply the provisions of ASB 16 leases because that transaction is already addressed by the proposed T3 standard. So what the ASB will be interested in feedback is whether you agree with its proposed approach to sending entities to the topic-based standards for only certain specified events and topics, and whether you agree with the matters for which the entity is required to apply the T1 recognition and measurement requirements. We will now move on to the detailed proposals for the accounting to be applied in preparing GPFS that comply with the T3 reporting requirements, where we will start with explaining what financial statements are required and how subsidiaries, associates, and joint arrangements of the preparer are treated in these financial statements. The T3ED proposes that T3 GPFS be composed of the same primary financial statements as would be presented in financial statements that comply with T2 reporting requirements. Different titles for the financial statements can be used as long as they are not misleading. So for example, an entity may use statement of surplus or deficit rather than a statement of profit or loss. Generally, the simplifications that applied in the board's proposals for the required set of financial statements of drafting and language and of presentation. A T3 GPFS must be presented in Australian dollars, and one period of comparative financial statements are required. So as shown on the slide, the components of the T3 GPFS are a statement of financial position and must be presented using a current or non-current classification, and a liquidity presentation is not allowed. Secondly, a statement of comprehensive income. A statement of comprehensive income can be presented as either a single statement of profit or loss and other comprehensive income, or as a statement of profit and loss plus a separate statement of comprehensive income, beginning with the profit for the period. The statement of comprehensive income should show the amounts of different categories of revenue where such disaggregation is relevant to an understanding of the entity's performance. Otherwise, this breakdown can be included as part of the notes to the financial statements. T3 GPFS must include an analysis of expenses either by nature or by function. This analysis can be made either on the face of the statement of comprehensive income or in the notes to the financial statements. The WSB has developed guidance to explain the classification by nature or by function. Please let us know whether the guidance is helpful to preparers in classifying and presenting useful information to users of the financial statements, or whether a more principles-based approach would be more helpful instead. Third, a statement of changes in equity which shows all the changes in the equity of the entity during the period. Besides profit and loss for the period, other changes to equity may include movements between equity reserve accounts or to recognize the correction of a prior period error. And finally, a T3 GPFS includes a statement of cash flows. In this statement, any cash flows from operating activities must be separately presented from other cash flows. Cash flows from investing and financing activities can be presented together, or like WSB 107, separately distinguished. T3 ED proposes to allow cash flows from operating activities to be presented using either the direct or indirect method as the same as T2 GPFS. However, as a simplification from the T2 requirements, the board decided not to require entities applying the direct method to disclose also a reconciliation of the net cash flows from operating activities to the profit and loss. So that's also not to require to present the indirect method information. And finally, the primary financial statements must also be accompanied by complementary note disclosures. The T3 ED sets out in various sections of the draft standard the disclosures that an entity must make in respect of transactions, balances, and other events that occur during the reporting period. In general, the board's proposed approach to T3 disclosures reflected in the ED is not to specify a disclosure objective, but simply specifying the disclosures that must be made in the T3 GPFS. The T3 ED proposes overall fewer disclosures compared to Tier 1 and Tier 2 reporting requirements, but likely still be more disclosures that might currently be made in a special purpose financial statements. We know also that some of the proposed T3 disclosures are not required by Tier 1 or Tier 2 reporting requirements, which is consistent with disclosures being used as a complement to simpler recognition and measurement requirements. Consistent with the Tier 2 reporting requirements set out in WSB 1060, the board is proposing to allow a couple of presentation alternatives to be required set of primary financial statements. So the first is to permit an entity to not present the OCI section of a statement of comprehensive income. An entity may stop the single statement of comprehensive income at the bottom line of profit or loss, or if the two-statement approach is adopted, the statement of comprehensive income that begins with profit for the period is not presented. This presentation concession is only permitted when an entity has no items of OCI in any of the period for which the financial statements are presented. The second presentation alternative relates to presenting a statement of income and retained earnings in place of the statement of comprehensive income and a statement of changes in equity. Put simply, the statement of income and retained earnings can be described as a combined statement of comprehensive income and statement of changes in equity. like the P&L statement with an additional section at the bottom to show the changes in retained earnings or accumulated surplus. An entity may present this replacement financial statement only when the entity's only changes to equity during the period for which the financial statements are presented arise from profit or loss or are opening balance adjustments relating to the correction of prior period errors or changes in accounting policy. The WSB is interested to know if you agree with its proposals for the components of the financial statements, including when a statement of income and retained earnings may be presented, and what information must be presented on the face of the financial statements. If you disagree with any of the proposals in this regard, please let us know and tell us why you disagree. We said that the T3ED proposes that comparative financial statements must be presented, but the board's proposals for the T3 GPFS is that comparatives are not reopened and restated. So changes in accounting estimates are reflected prospectively, that is, the current and future periods after the entity changes its assumptions, resulting in a change in the estimates. So there's no difference in the accounting for changes in estimates from what the entities will ordinarily apply now, or from Tier 1 and Tier 2 reporting requirements. However, with respect to changes in accounting policies and correction of prior period errors, the T3ED proposes that changes should be recognized retrospectively, but as an important simplification from Tier 1 and Tier 2 reporting requirements, the board is proposing to require any catch-up cumulative adjustments required to be made against the opening balances of the current period, rather than reopening the comparative financial statements. So the ED refers to this as the modified retrospective approach. The board formed its view on considering that the benefits of restating comparative information presented for prior periods may not exceed the related costs, since these adjustments are generally one-off in nature, and users may not regard such restatements as crucial. We note that the board's view has not changed from that expressed in the discussion paper. However, on reflection of the concerns expressed by stakeholders who disagree with adopting a modified retrospective approach for correction of prior period errors, the board decided to propose that entities must include a disclosure to signal to users that a modified retrospective approach has been applied to account for changes in accounting policies and corrections of prior period errors, and that the adjustments to opening balances for the current period are not reflected in the comparative information presented for prior periods. So let us know if you support or disagree with these proposals, including with the board's rationale for continuing to propose the use of a modified retrospective approach for both changes in accounting policies and correction of prior period errors. Besides events that look back, and there may be events that occur after the reporting date, but before the financial statements are authorized for issue. The draft T3 standard acknowledges the existence of these events and explains how they must be treated in the T3 GPFS. So like the WSB 110, events that shed light on conditions that existed at the reporting date, which are referred to as adjusting events, are reflected in the current period's results and balances. Events that indicate post-reporting date conditions, meanwhile, are not reflected in the current period's results and balances, but disclosures must be made of them in the financial statements. From the WSB's past research, the board understood that one of the hurdles stopping entities from preparing GPFS is the requirement to prepare consolidated financial statements. The reasons for not wanting to prepare consolidated financial statements are varied, but includes costs and complexities of identifying subsidiaries and preparing consolidated financial statements. The board formed a view in its discussion paper that the benefits of consolidated financial statements will not exceed its costs for the purpose of developing a third reporting tier suitable by use by smaller entities. While some stakeholders in the DP did express concerns about the potential absence of consolidated information from financial statements that are held to be general purpose in nature, and the sacrifice of comparability that might result from a decision to allow accounting policy choice for the accounting for subsidiaries, informing its proposals exposed in this ED, the board decided that these concerns were not ultimately compelling enough for it to significantly change its position from those set out in the discussion paper. So the T3 ED proposes simplification in the form of the provision of an accounting policy choice for parent entities, So a parent entity may consolidate its subsidiaries and prepare consolidated financial statements, and equity account its associates and joint ventures, and recognize its share of joint operations consistent with Tier 1 and Tier 2 reporting requirements, or it may simply present separate financial statements in which the subsidiaries are accounted for at cost, or fair value, or using the equity method. Changes in fair value of the subsidiary are recognized in profit or loss, or if the entity so elects, through other comprehensive income. And there's no recycling of any gains or losses presented in OCI on disposal of the investment. Under Tier 1 or Tier 2 reporting requirements, separate financial statements in which the subsidiaries are accounted for at cost or at fair value or using the equity method are additional financial statements and can only be prepared if the parent entity also prepares consolidated financial statements. The Tier 3 proposals is that these financial statements may be the only financial statements presented by a parent entity. Regarding the accounting for subsidiaries, associate and joint arrangements, the board is additionally proposing a further simplification in the form of classification requirements. So the Tier 3 ED proposes that a parent entity need not to separately distinguish entities it has control over from those it has only joint control and those that is able to only significantly influence. This simplification responds to stakeholders' concern that there's sometimes disagreement as to whether an entity is indeed controlled by the reporting entity. The ED proposes that an entity may categorize its subsidiaries, associates, and joint arrangements as a single class of assets described as notable relationship entities. This means that at a minimum, all an entity is required to do is identify whether it has at least significant influence over another entity. Where only a single class has been identified, rather than separately classifying entities as subsidiaries, associates, and joint arrangements, the same accounting policy, that is either at cost, fair value, or equity method, must be applied to account for all assets in that class. An analogy would be how different accounting policies may be applied to account for land and buildings, or if land and buildings were considered as a single class, there's only one accounting policy adopted. The draft Tier 3 standard proposes that the simplified requirements for the accounting of subsidiaries, associates, and joint arrangements will be accompanied by complementary disclosures. To complete the discussion on the accounting for the entities-related entities, similar accounting policy option exists in instances where the entity is not a parent entity, so when it has only associates and all joint arrangements. Associates and joint ventures must be measured at cost, fair value, or using the equity method, and the share of any joint operation recognized, or the entity may categorize and treat these investments as a single class and apply the same accounting policy to all investments in that category. The proposals for the accounting for subsidiaries, associates, and joint arrangements are set out across Section 8 and Section 13 of the exposure draft. So the WSP is seeking feedback on these proposals, and we will also welcome comment on how the requirements have been set out in the draft standard, whether it's clear how the standard is intended to operate in this regard. In this next section, we'll be discussing other proposals of the Tier 3 ED, focusing mainly on the board's recognition and measurement proposals for Tier 3 GPFS. We won't be addressing each section of the ED sequentially, but we'll be speaking to topics, so there will be some jumping back and forth in the ED. Also, not every topic or section addressed in the ED is listed on this slide, but we'll try to cover as much as we can. AASB 1058 and AASB 15 are the topic-based Australian accounting standards that specify revenue recognition rules for not-for-profit entities. And from outreach, we've heard that these standards may be too complex to apply for smaller not-for-profit entities and that the timing of revenue recognition is not necessarily helpful to users. Section 20 contains the guidance on revenue. So in the Tier 3 ED, the board is proposing to simplify these revenue recognition requirements for Tier 3 GPFS. The simplifications concerning revenue relate to the omission of uncommon requirements, simplifications of drafting and language, simplifications of revenue recognition and measurement requirements, and fewer disclosures. The board's proposals in the ED are largely consistent with its views expressed in the preceding discussion paper, being that revenue is deferred when an entity and the provider have a common understanding that the entity is to perform in a particular manner and that the action remains outstanding. For all other revenue transactions, revenue is recognized on the initial recognition of cash or other assets provided to the entity. Evidence of a common understanding includes written communication or other written or oral representations regarding the purpose for which an asset is to be expanded, transferred, or used up, or the period over which the transferred asset is to be used. A common understanding is less stringent than the sufficiently specific criterion specified by Tier 1 reporting requirements, and hence more transactions may qualify for deferral in the Tier 3 GPFS compared to a Tier 1 or Tier 2 GPFS. Also, the Tier 3 ED proposes that the enforceability of the common understanding of an arrangement is not necessary characteristics of a deferred revenue obligation. That is, it's possible for an entity to defer revenue recognition even in instances where the entity cannot be forced to return funds received if it does not perform as agreed. Now let's look at some examples of when a deferred revenue obligation liability might be recognized. So an entity has no unsatisfied obligation to perform for interest and dividend revenue that it receives. So a deferred revenue obligation liability will never arise in relation to these sources of revenue. Regarding the sale of goods and services, an example of an unsatisfied obligation is likely to be when the goods or services has not yet been delivered. Likewise with membership fees and the related membership period. For grants, a possible unsatisfied obligation of a capital grant, such as a grant to fund the construction of a building, might be when the building is not yet fully constructed. A possible unsatisfied obligation of an operating grant to help fund the operating expenses of a defined period could be that the period has not yet lapsed. And lastly, an example of unsatisfied obligation of an earmarked donation might be that the donated funds have not yet been used to fund that earmarked activity. We want to highlight that a deferred revenue obligation does not arise if grants or donations are given in expectation that the funds will be used to support the entity's running costs, but there's no defined period in which the monies must be used. Similarly, a deferred revenue obligation does not arise just because management, rather than the fund provider, has decided to deploy the funds received to a particular purpose. In such instances, the entity has no remaining unsatisfied obligation to perform, as there is no common understanding that the entity will perform in a particular manner resulting in the use up of the given funds. It's important to note that under the Tier 3 proposals, the timing of revenue release of any deferred obligation is not necessarily aligned to the related expenditure. For example, it does not automatically follow that $1,000 spent is matched by revenue recognition of deferred funds to that same amount. The criteria in the ED is that a deferred revenue obligation is recorded as revenue as or when an unsatisfied obligation is to perform are satisfied by the entity. This should be in a manner that most faithfully represents the amount and pattern of consumption by the entity of the resources received. Okay, so we've talked about the timing of revenue recognition. Now let's turn to measurement of revenue. This slide describes the measurement of different sources of revenue. While there's different sources of revenue, such as dividends and sales and grants and donations, the amount of revenue boils down to what the entity is expecting to receive, and this amount is unlikely to be different to how it's currently being recorded. Financing terms are ignored, that is, there's no discounting. And for other types of revenue, like interest and donation revenue from donated non-financial assets, the measurement of revenue may not be as straightforward. We'll be discussing interest and donation revenue as part of discussing financial assets and the various non-financial asset topics giving rise to interest and donation. For now, we just want to acknowledge that the measurement of revenue will normally be driven by the measurement of the related asset, and that different measurement is specified for different sources of revenue. The accounting for leases is addressed in Section 18. The T3ED proposes that an entity recognizes only lease payments and lease income. The lease remains off balance sheet so that if you don't own the leased asset, you don't recognize it. This is a significant simplification from WSB 16 leases. However, to complement the simplified recognition and measurement requirements, the ED proposes to require entities to make disclosures that will help users understand the entity's future obligations or receivables under the lease contract. As another simplification from Tier 1 and Tier 2 reporting requirements, both leases that are made on arm's length terms and leases made on concessionary terms, so that's your Pepicon leases, are accounted for in the same way. Again, here, to complement the simplified recognition measurement requirements, the ED proposes to require a lessee to disclose information about the nature and terms of the lease and about the entity's dependence on the donated assets under lease. It's important to note that the ED proposes that lease expense and lease income is recognized on a straight line basis unless another systematic basis is more representation of the time pattern of the lessee's benefit from the assets. So what this means is that any lease incentives, such as rent-free periods, are smoothed over the lease term. So the lease expenses may not fully match the actual lease payments, and it might be an asset or liability recognized for the differences. Please let us know if you support these proposals, and if you disagree, we'll be interested to understand why. The accounting for inventories is addressed mainly in Section 12 of the draft standard. The T3ED proposes that under the T3 reporting requirements, inventory is measured at cost and subject to impairment. While you might think, okay, this sounds consistent to the WSB 102, is the detail that's important. So there are several simplifications proposed with regards to inventory, including 1. Introducing accounting policy choice for the measurement of donated inventory, and 2. Simplifying the measurement requirements for inventory, including establishing that the carrying amount of inventory need only be tested for impairment when an impairment indicator is present. The cost of purchased inventory would normally be the consideration paid for them, whether paid immediately or on deferred terms. As not-for-profit entities often receive donations for inventory, whether for free or at discounted prices, the draft T3 standard also addresses how costs could be measured for such inventory. So under the ED proposal, and as a simplification from WSB 102, an entity may measure the cost of donated inventory as its current replacement cost, or it can elect to measure the inventory at the amount of consideration paid for the inventory, so nil if the inventory was free. If donated inventory is measured at cost, similar to leases, to complement the simplified recognition and measurement requirements, the ED proposes requiring the disclosures of information about the nature and terms of the donation arrangements and about the entity's dependence on donated inventory. So let us know if your views on an entity's possibly measuring donated inventory at nil and whether the complementary disclosures is sufficient replacement to the measurement policy. If inventory is measured at current replacement costs on initial recognition, any related credit amount is recognized in profit or loss as donation income. The T3ED proposes that an entity includes in the cost of inventories all costs incurred in bringing the inventories to the present location and condition, including for inventories produced by the entity, cost of conversion. The cost of conversion will ordinarily include a systematic allocation of production overhead costs incurred in the conversion process, such as a share of the depreciation and maintenance costs of building and equipment used to produce the inventory. As another simplification of recognition and measurement from T2 reporting requirements, the T3ED proposes to allow entities to exclude such allocation of production overhead costs from the cost of inventory. So that in effect, if the entity so chooses, the entity does not need to attribute these indirect costs to the cost of inventory. So for example, an entity may choose to do so because it does not currently apply such costs as part of its inventory costing process. And it's important to remember that that's an accounting policy election and must be applied consistently to all inventories produced by the entity. Now, inventory is only tested for impairment when an impairment indicator is present at the reporting date. The T3ED proposes two impairment indicators. So that's when the item is damaged physically, or is perishable item that has spoiled, or it has become obsolete, or the entity's change its strategy or being affected by a reduction in external demand for its goods or services. And in either case, the asset's capacity to provide goods or services or generate sales income might have been affected adversely as a result. The guidance on impairments, including impairment indicators, are set out in section 23 of the draft standard, and you'll be hearing me refer to this section for the next two slides as well. So as you can see, because of the nature of these impairment indicators and because impairment is only considered at the reporting date, the timing of impairment recognition may possibly be later compared to when a write-down might be required under the T1 or T2 reporting requirements. When an impairment indicator is present, the entity must assess the recoverable amount of the inventory, and if it's lower, write the carrying amount of inventory down to its recoverable amount. The T3ED proposes that the recoverable amount of an item of inventory depends on whether it is held for distribution or otherwise. An example of inventory held for distribution would be your food banks, stock of pantry items to be included in food parcels. The T3ED proposes that the recoverable amount of inventories held for distribution is the cost less the loss of service potential. Loss of service potential is measured by reference to the more easily determinable of the cost or replacement cost of those inventories held that are no longer useful for distribution, based on the judgment of the entity's management. So for example, inventories held that are no longer useful for distributions are items that are damaged or outdated. And the draft standard includes two illustrated examples to help illustrate how the loss of service potential of inventory might be identified and measured. The recoverable amount of all other inventory, a group of similar items of inventory, is the selling price of the item less cost to complete and sell it, and write-down of inventory is recognized in profit or loss. Property, plant, and equipment is covered in section 15, and impairment guidance, as mentioned before, is in section 23. Similar to inventory, the high-level measurement requirements are the same as T2 requirements, so that's for PP&E to be initially measured at cost and subsequently using either the cost model or the revaluation model. For today's presentation, we'll assume that people are familiar with the requirements of a cost model and revaluation model, so we'll won't be explaining the mechanics here today. The T3 proposals are simplifications compared to WSB 116, which include that the cost of self-constructed PP&E doesn't need to include an allocation of the depreciation of its other assets that were used to build the PP&E. And there's an accounting policy choice for the initial measurement of donated PP&E, but the choice is between measuring the item initially at its cost, which could be nil, or the fair value of the item. And similar to inventory, if the donated PP&E is initially measured at its cost and subsequently on the cost basis, disclosures will need to be made by the not-for-profit entity's reliance on the donated PP&E and of the nature and terms of the arrangement. Again, like inventory, the entity must estimate the asset's recoverable amount only when an impairment indicator is present at the reporting date. The recoverable amount of an item of PP&E is the higher of its fair value, less cost to sell, and its value in use. When the recoverable amount is lower than the PP&E's carrying amount, the carrying amount is written down and an impairment loss or a revaluation decrement is recognized. The impairment indicators are the same as those for inventory. In addition, when and only when an impairment indicator is present at the reporting date, the entity is required to review the assumptions and judgments it's made regarding the PP&E's residue value, useful life, and depreciation method. But there's also one further time when the entity must reassess its depreciation method, and that's when there is an indication of significant change in the expected consumption pattern of the PP&E's future economic benefits. So under the T3 proposals, it's important that an entity gives sufficient due consideration to its assumptions about a PP&E's residue value and useful life, because any changes are only permitted in limited circumstances. For investment property, which is covered in Section 14 of the draft standard, the headline requirements of WSB 140 apply, and the simplifications and requirements are similar to which I've already covered for PP&E. One further simplification from Tier 1 and Tier 2 reporting requirements which is not mentioned on the slide, is that the T3 ED proposes a blanket rule that mixed-use property, that is, property that is partly deployed for investment purposes and partly for own use, must be classified as PP&E. WSB 140, on the other hand, requires the entity to apply judgment in determining how to classify such property. The difference between PP&E and investment property is that investment property must subsequently be measured using the fair value model rather than a revaluation model. Under the fair value model, the asset must be measured at fair value at each reporting date, and any changes in fair value are recognized in the profit loss. Now, just a couple of notes about the fair value model. An entity can elect to measure its investment properties using the fair value model, but in applying that model, only properties that have reliably measurable fair value are measured at fair value. Those investment properties whose fair value cannot be measured reliably on a continuum basis must apply the cost model measurement requirements, but using the last reliable fair value measurement as the asset's cost, until such time as its fair value is once again reliably measurable. There are some small differences, minor simplifications between the proposed T3 requirements in this regard and the requirements in WSB 140. For example, under T1 and T2 reporting requirements, the entity is not permitted to subsequently revert to measuring that particular investment property at fair value. Like for PP&E and investment property, the proposed T3 recognition and measurement requirements for intangible assets remain fairly consistent to T1 requirements, that is WSB 138 intangible assets. The simplifications and requirements are similar to the proposals for PP&E, being that the initial measurement is at cost, or for donated intangible assets, cost of fair value, and that impairment is assessed only at reporting date and only if an impairment indicator is present. The same limited impairment indicators apply. Similarly, assumptions about an intangible asset's useful life, residual amount, and amortization method are only reviewed where an impairment indicator is present. However, there are a few proposed differences from WSB 138. These simplifications eliminate some judgment and costs compared to what's required by existing requirements. The first is that the T3 ED proposes that all expenditure relating to internally generated intangible assets, such as research and development costs, should be expensed, whereas WSB 138 would have permitted development costs to be capitalized if it meets certain criteria. And second is that all intangible assets are amortized over the useful life, including an intangible asset with an indefinite useful life. The draft T3 standard proposes that an intangible asset with an indefinite useful life should be amortized over a period of no longer than 10 years. We encourage everyone to read the ED to consider whether you support the proposals for non-financial assets, which is inventory, PP&E, investment property, and intangibles. For example, do you agree or disagree with the proposals to recognize donated assets at cost or fair value? Do you support reviewing assumptions used in estimates only if there's been a trigger event at the end of the reporting period? And is it appropriate that an entity immediately expense all costs incurred in building a website? WSB 9 financial instrument is one of the many challenging accounting standards to understand and apply, especially for smaller entities. So the board thought it was necessary to develop T3 requirements for those financial instruments that would be most commonly held by smaller not-for-profit private sector entities, and the guidance is contained in Section 10 of the draft standard. Financial instruments that are most commonly held by smaller not-for-profit private sector entities are described in the ED as basic financial instruments and are listed on the left-hand side of the slide, such as cash and cash equivalents, trade receivables, and trade payables and term deposits. However, the board decided that it should not develop specific T3 accounting requirements for other financial instruments, in particular those financial instruments that would ordinarily be regarded as more complex. The board's thinking is that entities that will engage in these types of financial instruments will be able to apply the more complex accounting requirements set out in WSB 9. As you can see, some of the more complex financial instruments identified by the board includes purchase debt instruments such as unlisted corporate bonds and also derivatives. As derivatives are outside the scope of the proposed T3 standard, and an entity is directed to instead apply the accounting specified by WSB 9, it follows that hedge accounting could be possible. However, the board proposes not to permit hedge accounting at all. So the T3ED proposes a blanket rule that hedge accounting is not permitted for entities preparing T3 GPFS. What we'll be interested from you is whether the list of basic financial instruments are those identified as more complex have been identified correctly. Should these basic financial instrument lists be a guide only, or is the list complete and a boundary to the types of financial instruments of which the accounting is specified by the draft T3 standard rather than WSB 9? Financial assets that are basic financial instruments are in general initially measured at fair value, but to simplify the requirements from WSB 9, the draft standard proposes that any directly attributable transaction costs and fees to acquire the financial instruments are excluded from its fair value at initial measurement and immediately expensed. The draft standard also proposes that the consideration to which the entity expects to be entitled should be assumed as the fair value of trade and other receivables. As you can see on the slide, the only type of basic financial asset that's not initially measured at fair value is a concessional loan made to another party, for example, an interest-free loan given to a subsidiary. And these financial assets will be initially measured at transaction price of the arrangement. So this proposed measurement is consistent with the T3ED proposals to allow concessionary leases and donated non-financial assets to be initially measured at their cost. But unlike those items, there's no alternative measurement permitted here. And the board formed this decision to specify this measurement basis after considering its proposals for measurement of interest, and also requiring a fair value measurement for concessionary loans would be complex for small entities. So the T3ED also proposes simpler subsequent measurement requirements. Unlike WSB 9, there's no requirement to classify financial assets based on whether a business model test or solely payments of principal and interest tests, or to measure interest having regard to an effective interest rate. Instead, the ED proposes that all financial assets, other than those that are held to generate both income and capital return, are simply subsequently measured at cost, less impairment. Financial assets that are held to generate both income and capital return, for example, shares, are required to be measured at fair value through profit or loss, or, as a day one accounting policy election, fair value through other comprehensive income. Changes in a financial instrument's fair value presented in other comprehensive income are never recyclable, whether the financial instrument is a debt security or an equity instrument. Now, some of the financial assets may be foreign currency monetary balances. For example, a charity that has overseas operations might have foreign currency cash holdings or need to pay employees and suppliers in the local currency. The T3ED proposes that besides translating any foreign currency transactions into Australian dollars on the transaction date, all foreign currency monetary balances must be retranslated using the exchange rate at the reporting date. Also, some financial assets held might be interest-bearing financial instruments, for example, term deposits. The T3ED proposes that interest income be measured simply as the product of the carrying amount of the financial asset at the beginning of a period and its contractual interest rate. Now, up to this point, we haven't commented much on the recognition requirements, and that's because for many of the topics addressed so far, the timing of recognition and derecognition of assets wouldn't be too different from current practice. And the same with the timing of recognition of a financial asset is not likely to change as a result of the board's proposals in the T3ED. However, the board decided to propose simpler derecognition provisions compared with WSB 9. The T3ED proposes that a financial asset that is a basic financial instrument should be derecognized when the entity's contractual rights to the instrument expires or are settled, or if an entity loses control of the asset. The draft T3 standard also doesn't include guidance to specify requirements of complex derecognition scenarios, for example, pass-through arrangements or instances where the entity retains continuing development in the financial asset. Not addressing such scenarios is consistent with the nature of the reporting tier. However, this also means that it's possible that some financial assets might be de-recognized earlier under the T3 requirements than if a T1 or T2 reporting requirements have been applied. Financial assets measured at cost are subject to impairment. For example, a trade debtor must be written down when the receivables recoverability is uncertain. The T3ED proposes that a financial asset is assessed for impairment only when there is objective evidence of impairment at the end of the reporting period. This proposed impairment model could be described as an incurred loss model. An entity should apply judgment to decide whether it should assess an individual financial asset for impairment, or whether it may assess impairment for a group of assets with similar credit risk characteristics. Now, when is there objective evidence of impairment? The draft standard includes examples of instances where objective evidence exists, raising questions about the recoverability of a financial asset. These include when there has been observable data about loss events that has come to the attention of the holder, and when there has been significant changes with an adverse effect in the technological, market, economic, or legal environment in which the debtor or financial instrument insurer operates. In the blue box on the slide includes examples of loss events. Look down the list and you'll see that a loss event could be something specific to the financial asset, such as the issuer being in significant financial difficulty or having breached its contractual terms, or more general events such as in industry or the country's economic conditions worsening such that there's a quantifiable decrease in the expected future cash flows associated with financial assets relating to that industry. When a financial asset must be assessed for impairment, the entity is required to estimate the present value of the estimated cash flow it expects to receive. The amount of the impairment loss is the difference between the carrying amount of the financial asset and the present value of the estimated cash flows it expects to receive, and is recognized immediately in the profit and loss. The contractual interest rate is used in the present value calculation as the relevant discount rate. We'll now discuss the proposals for the accounting of financial liabilities that are basic financial instruments. Like financial assets, the T3ED proposes that financial liabilities that are basic financial instruments to generally be initially measured at fair value and subsequently at cost. For concessional loans received, that's borrowings of an entity's accounting for financial liabilities, is also simplified from WSB 9 and are similarly initially measured at the loan's transaction price rather than fair value, and interest expense is measured consistently to interest income, so that's the product of the carrying amount of the financial liability at the beginning of the period and its contractual interest rate. The EED also proposes another simplification for interest. Currently, WSB 123 borrowing costs requires borrowing costs that relate to a qualifying asset, for example, PP&E constructed over several years to be capitalized as part of the cost of that PP&E, while the T3ED proposes that all borrowing costs to be expensed. The WSB has also decided to propose simplifying the derecognition provisions of WSB 9 for financial liabilities. Under the proposals, a modification of the terms of a financial liability or an exchange of a debt instrument for a different debt instrument is treated as extinguishing the original financial liability. Unlike WSB 9, an entity isn't required to investigate whether the original financial instruments has been subsequently modified before de-recognizing the original liability. And if there's been a modification, the carrying amount of that relevant liability will in effect reset as a new fair value if the proposed accounting is applied. Now there's one further financial liability that not-for-profit entities occasionally incur, and that's income tax obligation. Income taxes were not identified in the listing of basic financial instruments on the slide we previously considered. That's because the T3ED proposes specific requirements for these obligations. Income taxes are addressed in Section 25 of the draft T3 standard. The board proposes that only current tax expenses and any associated current tax liability need to be recognized and not to recognize any deferred tax assets and deferred tax liabilities. The tax expense is measured with reference to the tax assessment amount, which is a known obligation. But if that's not available, then by reference to the submitted tax return. And if that's also not available, then the entity's best estimate of its income taxes for the period. Moving on now to provisions, our last balance sheet liability discussed today. The T3ED proposes requirements for provisions for employee benefits and other provisions. These are set out in sections 24 and 19 respectively. For provisions, the simplifications from Tier 1, which is WSB 137, and Tier 2 Australian Accounting Standards are a simplification of drafting and language, simplification of measurement requirements, and for fewer disclosures. Consistent with WSB 137, the T3ED proposes that under the T3 reporting requirements, an entity will recognize a provision only when the entity has a present obligation, so legal or constructive, as a result of a past event. It is probable, so that's more likely than not, that an entity will need to transfer assets to another party in settling the obligation, and the entity can make a reliable estimate of the amount of the obligation. However, in contrast to WSB 137 and consistent with the proposed requirements for employee benefits, as the simplification, the provision is measured at the entity's best estimate of the amount to be paid, taking into account current information about condition existing at the end of the reporting period, rather than its best estimate of the expenditure required to settle the present obligation at the end of the reporting period. The difference from WSB 137 is that the proposed mechanics of the T3 measurement model requires an entity to consider only current prices and rates and not expected future prices, and not to discount these amounts. So the draft standard provides an example, taking current contractor rates into account in estimating the cost to an outstanding obligation to clean up an event site. Similarly, current contractor rates would be used in estimating the provisions even if the obligation was only due to be settled several years into the future. So it follows then, because the entity is required to measure the provisions based on current prices and reflecting current conditions, the measurement of provisions could change from period to period until the provisions is settled at the cost of settling that provision, the amount to be paid. So for example, labour rates could increase year to year. Changes in the provision amount are recognized in profit or loss in the period of the change. The proposed Section 24 contains the requirements for employee benefit provisions, which are consistent with the recognition and measurement criteria applying to provisions generally. For simplicity, T3ED proposes that all obligations due to employees are described as a provision. Besides accrued wages and salaries, accrued contribution to defined contribution plans, or other similar payable amounts due, a provision for employee benefit is recognized only in respect of vesting, accumulating leave entitlements earned but not yet taken. These are employee entitlements that are not of a use it or lose it nature, and which would get paid out to the employee if the employee left. They will ordinarily include, for example, your annual leave or long-service leave entitlements. A provision is not recognized for non-vesting leave entitlements and non-accumulating leave not yet taken. For example, sick leave and time in lieu that does not carry forward. Such employee benefits are simply expensed as leave is taken or entitlement used by the employee. The T3ED proposes requiring an employee benefit provision to be measured at undiscounted amount of employee benefit expected to be paid. Obviously, some amounts are known, so like your accrued wages, while other amounts must be estimated. One example of that is your long service leave. So some employees might leave before their entitlement vests to them. In estimating long service leave provisions, an entity takes into account the likelihood that any long service leave unvested at the end of the reporting period will vest in the future period. Also, the provision for long service leave may be estimated using a most likely outcome approach. Before we move on to the next topic, we just want to remind you that employee benefits in the form of share-based payments and contribution to defined benefit plan must apply WSB 2 and WSB 119 to these forms of employee benefits were offered, as these are one of the topics which I've mentioned earlier that are specifically required to apply the T2 requirements. That was the last asset or liability specific topic. Over the next few slides, we'll be discussing other aspects set out in the draft T3 standard. So that's fair value measurement, entity combinations, and 2 disclosure topics, commitments and contingencies, and related party disclosures. In various places, I've mentioned that the T3 ED proposes to allow or require various transactions or balances to be initially or subsequently measured at fair value or on a fair value basis. So what is fair value measurement? Fair value is not directly defined in the T3 standard, but the objective of fair value measurement is to have a consistent definition of fair value in WSB 13 fair value measurement. The T3 ED proposes that the objective of a fair value measurement is to estimate the price at which an orderly transaction to sell an asset or to transfer a liability would take place between market participants at the measurement date under current market conditions. Similarly, the characteristics of fair value are generally consistent to those identified in WSB 13. That is, it must include the characteristics like item condition and location that market participants would take into account in pricing the item, and that for PP&E and other non-financial assets, the fair value estimate references the highest and best use of the asset. However, the board decided to provide a simplification in respect of highest and best use, where the ED proposes to include a rebuttable presumption that non-financial assets' current use is its highest and best use. So if an item is not likely to be sold within 12 months, its current use may be presumed to be its highest and best use. The T3 ED describes when fair value is readily measurable. So as you can see on the slide, the fair value of an asset or liability is reliably measurable if the market price of an identical asset or a similar asset is observable close to the measurement date, or either the verifiability in the range of reasonable fair value measures is insignificant for that asset, or probabilities of the various measures within the range can be reasonably assessed and used in estimating fair value. In estimating fair value, the draft standard does not require the application of fair value hierarchy to determining fair value, but simply proposes that the use of observable inputs is maximized and the use of unobservable inputs is minimized. Now, in some cases, even if an entity elects or is required to measure a particular asset or liability at fair value, it may not be able to do so because the range of reasonable fair value measures is significant, and the probabilities of various measures cannot be reasonably assessed. The T3 ED proposes that an entity is precluded from measuring the asset at fair value in these instances. Instead, the last reliable measure of fair value is assumed as the item's deemed cost until fair value is again reliably measurable. Also, the T3 ED includes guidance explaining that cost might be an appropriate proxy for the fair value of an unlisted equity instrument, but only in limited circumstances. These circumstances include when there is insufficient, more recent information available to measure fair value, or if there is a wide range of possible fair value measurements and cost represents the best estimates of fair value within that range. The draft standard clarifies that cost will never be a best estimate of fair value for listed equity instruments. One instance in which Tier 1 reporting requirements require assets and liabilities to be measured at fair value is in respect of business combinations. The proposed T3 standard does not refer to business combinations, but uses the term entity combinations instead, and the guidance is contained in Section 17. The board considered entity combinations better aligns with the operating environments of smaller not-for-profit entities. The WSB had initially proposed not to develop guidance on combination accounting for its T3 reporting requirements. However, stakeholder feedback received from the discussion paper indicated that business combinations may not be uncommon, and that there may be an increasing trend for entities to merge or acquire other entities. The accounting for combinations is relevant even where a parent entity decides not to consolidate its subsidiaries, because an entity combination occurs also in instances where an entity acquires the net assets rather than the equity of another entity. After considering the stakeholder feedback, the board decided to develop T3 reporting requirements for the accounting for combinations. The board formed a view to depart from T1 requirements and to require instead a book value method. Under the proposed book value method, the combination is treated as having occurred at the beginning of the current period to avoid costs of trying to establish when the combination occurred, which may not always be obvious. Assets, liabilities, and equity of the acquired entity are recognized at the pre-combination book values. However, if accounting policies differ between the combined entities, then the balances must be adjusted for uniformity. And when an acquired material asset that was not a donation or liability was measured at nil in the acquired entity's books, the item must be remeasured to its fair value at the beginning of the current period. The board decided to propose this requirement because some assets and liabilities may not currently be recognized in special purpose financial statements. Finally, under the book value method, the T3ED proposes that the differences between the consideration paid and the recognized net assets to be directly in equity. This means no goodwill or discount on bargain purchases arises as a result of applying book value method to an entity combination. Section 19 covers guidance on commitments, contingent liabilities, and contingent assets. The T3ED proposes that contingent liabilities and contingent assets are not recognized, but to require disclosures of the contingencies to be provided in the notes to the financial statements. For contingent liabilities, this includes instances where the entity acquires a contingent liability in a transaction that is treated as an entity combination. This is a point of difference from Tier 1 and Tier 2 reporting requirements, but the accounting for entity combination is different overall in any case. Contingent assets are possible assets. A pledge is a promise made by a donor to contribute assets to the entity in the future. Consequently, pledges are a type of contingent assets as their existence will be confirmed only by the occurrence or non-occurrence of an uncertain future event. Under the proposals, an entity will need to disclose a brief description and its best estimate of the amount of the contingent asset, which an entity may or may not actually do. Likewise, firm future commitments are generally not recognized, as a present obligation generally does not exist. The WSB proposes, as set out in the various sections of the ED, requiring an entity to disclose information about its significant firm commitment to purchase goods, services, or other assets as the board consider this information to be useful to users for assessing the entity's future funding requirements. For example, the T3ED proposes that an entity must disclose the amounts of contractual commitments it has to acquire PP&E and its future minimum lease payment obligations. When responding to the discussion paper preceding this exposure draft, stakeholders provided feedback to the board on the importance of related party disclosures for users of T3 GPFS. Therefore, this ED includes requirements to disclose information about the entity's related party transactions, balances, and those relationships. The definition of related party is similar to WSP 124 and includes key management personnel of the entity and close family members of any persons identified as being a related party to the entity. The proposed related party disclosure requirements are generally consistent with the disclosures required by T2 reporting requirements, but the T3 proposes simplifications of not requiring disclosures of key management personnel compensation and donations from a related party, except in instances where the donation was made on terms that could influence the entity's activities or use of its resources. The board decided these simplifications on the basis that related party donations typically don't affect an entity's independent interests, and there's already legislation that requires some not-for-profit entities to disclose key management personnel compensation. There's one aspect of disclosure that differs from the T2 reporting requirements, and that's the T3ED proposes for the accounting of notable relationship entities, which is a concept that doesn't exist in the T2 reporting requirements, and that related party disclosures also covers those notable relationship entities. In this next section, we'll talk about the ED proposals for movements from SPFS to GPFS and between reporting tiers, including on first-time adoption of the final pronouncements. We will also discuss the proposed effective date of any final pronouncements resulting from the exposure drafts. Just a note before we begin, both the Conceptual Framework ED and the T3ED makes proposals in respect of transitions from SPFS to GPFS and between reporting tiers. So ED 334 sets out the board's proposals for movements from SPFS to Tier 1 and Tier 2 GPFS, and from Tier 2 unconsolidated to Tier 2 consolidated GPFS. And ED 335 sets out the board's proposals for the preparation of T3 GPFS, whether for the first time or on resumption of the T3 reporting requirements after a period. It also sets out the proposals for transition from T3 GPFS to Tier 1 and Tier 2 GPFS. Okay, let's look at the proposals for an entity moving for the first time from SPFS to Tier 1 GPFS and from unconsolidated Tier 2 GPFS to consolidated Tier 2 GPFS. Regarding transition of SPFS to Tier 1 GPFS, the board's view is that an entity should apply WSB1 in preparing the first Tier 1 GPFS, and that no further specific transitional provisions are necessary. The board's basis for this view was that for-profit private sector entities preparing Tier 1 GPFS for the first time weren't providing specific transitional requirements on transition as a result of the board's project to extend Australian accounting standards to them. And there's not likely a significant majority of affected not-for-profit entities that will be required to commence preparing Tier 1 GPFS when they are no longer preparing SPFS. And that's based on research from WSB Research Report number 5, Financial Reporting Requirements Applicable to Charities, which didn't indicate that not-for-profit private sector entities needed to lodge Tier 1 GPFS. Also, the board's previous research and feedback from its targeted outreach to public sector stakeholders suggested that the use of SPFS in the public sector is expected to be limited, and the WSB1 already includes specific additional provisions for not-for-profit entities, most recently in respect of certain leases held by such entities. Next, regarding transition of SPFS to Tier 2 GPFS and of Tier 2 unconsolidated GPFS to Tier 2 consolidated GPFS, the board considered that an not-for-profit entity should apply the same requirements and have access to the same transitional relief to those made available to for-profit entities as part of the earlier WSB project. So if the entity does not already apply Tier 2 recognition and measurement requirements, it must apply WSB1 or the Tier 2 reporting requirements directly. If the entity already adopts Tier 2 recognition and measurement accounting policies, the entity doesn't apply WSB1. The proposed transitional relief in the first Tier 2 GPFS relates to optional relief from having to distinguish errors from changes in accounting policy, present comparative information that was not previously disclosed, and to restate comparative information. However, these optional reliefs will only be available to early adopters of the draft standard. These are the same relief as those given to for-profit entities, as the board considered the same circumstances and conditions are now valid for not-for-profit entities. The board also decided that limiting the relief to early adopters will incentivize early adoption of the proposed final standard. Not-for-profit private sector entities have the additional option to prepare Tier 3 GPFS if the entity is required to transition from SPFS to GPFS or chooses to prepare Tier 3 GPFS on finalization of the board's proposals, unless the entity is publicly accountable or restricted from preparing Tier 3 GPFS. Now, the procedure and transitional requirements that apply to an entity moving from SPFS to Tier 1 GPFS are set out in WSB1, and the procedures and transitional requirements that apply to an entity moving from SPFS to Tier 2 GPFS are set out in WSB 1053. The T3 ED proposes a third location for the procedures and transitional requirements that apply to an entity moving from SPFS or from Tier 1 or Tier 2 GPFS to Tier 3 GPFS for the first time, being within the Tier 3 standard. However, WSB 1053 provides the starting point for each of these transitions and also for other transition scenarios. The T3 ED proposes that when applying Tier 3 reporting requirements for the first time, an entity should elect to either apply the requirements for changes in accounting policies set out in Section 9 of the draft Tier 3 standard. So that's recognizing the effect of any changes to Tier 3 compliant accounting policies on a modified retrospective basis, or apply the procedures and specific transitional provisions set out in Section 29 of the draft T3 standard. Section 29 specifies recognition and measurement rules and reliefs, which I'll talk about soon. The T3ED proposes presentation and disclosure relief for the first T3 GPFS under either of these alternatives. The exposure draft proposes relief for not-for-profit entities from distinguishing errors from changes in accounting policies, and also from relief from needing to present comparative disclosures for those disclosures that it didn't previously make. Now, what is the proposed transition date? When applying T1 reporting requirements, the transition date is the opening balance date of the earliest comparative period presented. So if an entity's first GPFS end was 30th of June 2030, the T1 transition date would have been 1st of July 2028 if the entity doesn't early adopt the issued pronouncement. And the same requirements apply for a not-for-profit entity preparing T2 GPFS, whether consolidated or not, for the first time. For T3 GPFS, the transition date depends on which section an entity elects to apply. So if a modified retrospective application applies, then that's the beginning of the current period for which the T3 standard is first applied. And if Section 29 was adopted, the specific transitional provisions applies, which is the beginning of the earliest period for which the entity presents full comparative information in accordance with the T3 standard in its first financial statements that conform to the T3 standard. Now, under the modified retrospective application, the identification of the transition date doesn't have too much impact as the entity is required to adjust its balances as though the T3 accounting policies has always applied. In contrast, if an entity elects to account for its first transition from SPFS or another reporting tier to T3 GPFS using the specific transitional provisions set out in Section 29, then the identification of a transition date is important. That's because certain transitional relief provisions have regard to this point in time. The T3ED proposes SOLs required the beginning of the earliest period for which the entity presents full comparative information in accordance with the T3 standard in its first financial statements that conform to the T3 standard would generally be considered the same date to what's required under the T1 reporting requirements. However, it's also important to keep in mind that there's another provision in the section that states that an entity need not disclose comparative information in its first T3 financial statements if it did not disclose comparable information in its most recent previous financial statements. So that impacts what's the transition date for that entity that elects to apply that relief from correcting its comparative period information. If an entity does not elect to apply the modified retrospective application approach in Section 9 in preparing its first T3 GPFS, the entity must apply the requirements of Section 29, and Section 29 can be considered as being the T3 equivalent of WSP1. In short, Section 29 proposes requiring an entity to apply all the T3 recognition, measurement, and classification requirements on and from the transition date, except that the entity is permitted to apply the T3 revenue requirements only to new contracts and arrangements. 2, permitted to continue to recognize existing financial assets and financial liabilities that are not otherwise recognizable. 3, previously derecognized financial assets and financial liabilities stay derecognized. 4, the entity does not revisit previous estimates, fair value measurements, or any split of retained profits between a parent entity and the non-controlling interest. And 5, the entity is permitted to make day one elections and to use a specified measure on transition date as cost, which is referred to as deemed cost. And for example, so the fair value of PP&E on transition date may be regarded as its cost going forward, rather than its written down original purchase price. The specified measure depends on the asset or liability in question. For example, the deemed cost of inventory is not its transition date fair value, but its current replacement cost on transition date. Day one elections refer to decisions that would ordinarily have been made at the time the asset or liability was originally acquired. For example, whether a financial asset should be measured at fair value through profit and loss or at fair value through other comprehensive income. There's one additional specific transitional provision applicable only to entities transitioning from preparing T1 or T2 GPFS to preparing T3 GPFS for the first time. This additional specific transitional provision relates to the continuation of existing recognition and measurement requirements. For entities transitioning from preparing Tier 1 or Tier 2 GPFS to preparing Tier 3 GPFS for the first time, the T3 ED proposes to allow an entity that applies the specific transitional provisions of Section 29 in preparing its T3 GPFS to continue to apply its existing R&M policy to some or all of its existing assets or liabilities. In those circumstances, the T1 or T2 disclosure requirements applying to those assets or liabilities must continue to be made in the T3 GPFS. The T3 ED also makes proposals for other reporting tier movements to or from T3 GPFS. These proposals will be amendments to WSB 1053 rather than being located as part of an eventual T3 standard. So for a T3 GPFS step up to a T1 GPFS, the draft standard proposes that the entity applies WSB1 and for there to be no new transitional provisions offered to facilitate that transition. For a T3 GPFS step up to T2 GPFS, the draft standard proposes that an entity applies WSB1 or the T2 reporting requirements directly. Similar forms of transitional relief to that described previously, that is, regarding distinguishing errors and presenting comparative information, are proposed to be available to entities in a year of the step up. The proposed relief goes beyond that what will be available to for-profit private sector entities on adoption of WSB 1060. On resumption of the T3 GPFS, the proposed requirements depends on whether the entity's accounting policies before the transition comply with T3 accounting policies or not. If they do, the T3 ED proposes that the accounting continues. For example, no reset of costs will be available to the entity. And if they don't, the T3 ED proposes that the entity approaches the reapplication of the T3 reporting requirements as though it were a first-time adopter of the T3 reporting tier. Now, what's the proposed effective date of the proposals in ED 334 and ED 335? The board has proposed that the effective date will be at least 3 years after the issue of its final pronouncements and early adoption will be permitted. So as shown in the example, if the board completes its redeliberations and issues the standard by the end of 2025, the effective date of the pronouncements will not be before 1st of January 2029. So a June year-end reporter's first GPFS might be for the year ending 30th June 2030. Now this sounds like a very long time away, but the board decided that it should propose a longer implementation period because of the feedback it received on the discussion paper and the lessons learned from its work to extend GPFS to more for-profit private sector entities. Of course, one key difference between the projects for for-profit private sector entities and this project is that general purpose financial statements for for-profit private sector entities had to comply with, at a minimum, the Tier 2 reporting requirements, while many not-for-profit private sector entities is expected to have access to the simpler Tier 3 reporting requirements. The board considered this when forming its proposals for an effective date, but was also cognizant that some not-for-profit private sector entities that are currently preparing SPFS would need to be moved to Tier 1 or Tier 2 reporting requirements instead of Tier 3 GPFS. The board has concern that these entities may require longer transition period. So the board's seeking specific feedback on its effective date proposals. We want to know if you agree for the proposed period between the issue and the effective date will be longer than usual, and whether there's any reasons for an earlier effective date, even if entities are able to early adopt the standard if they wish.
Of course, we do not want to finish this webcast without circling back to Exposure Draft 334. The exposure draft that extends the conceptual framework to not-for-profit entities and as such would result in more not-for-profit entities preparing general purpose financial statements. To recap, elsewhere in this presentation we have covered that the exposure draft 334 makes following proposals. First, it extends the conceptual framework to not-for-profit entities, and as part of doing this supersedes the existing not-for-profit conceptual framework and SEC 1. Secondly, as a result of superseding SEC 1, the WSB found it necessary to revise the application clauses of Australian accounting standards, which pointed to the reporting entity. The board is proposing to extend the population required to prepare general purpose financial statements to those not-for-profit entities required by legislation or a constituting or another document to prepare financial statements in accordance with Australian accounting standards. However, exempting those whose constituting or another document was created and last amended before a standard takes effect. Thirdly, for those exempted under the constituting document exemption, the board is proposing that any special purpose financial statements prepared must comply with certain AASB 1054 disclosures that will have users understand the basis for the financial statements, the accounting policies applied, and the extent to which the financial statements differ from general purpose financial statements. And finally, the transitional provisions for those entities that currently prepare special purpose financial statements and will prepare GPFS Tier 1 or Tier 2 in the future if the proposals are finalized as exposed. In closing, we want to briefly highlight the primary aspect of the board's project to extend the conceptual framework to not-for-profit entities, being the proposed amendments to ensure that the conceptual framework is suitable for not-for-profit entities. Following the board's analysis and considerations of extending the conceptual framework, the board decided that the pronouncement, with limited additions, is suitable for use as a framework document for not-for-profit entities. In the main, the proposed additional OS paragraphs are carry-forwards of the OS paragraphs in the current conceptual framework applicable to not-for-profit entities. The proposed amendments recognize, amongst other matters, that users of not-for-profit financial statements are likely to be more concerned with the ability of the entity to achieve its objectives rather than primarily in a financial return. Therefore, amendments aim to delink the notion of economic benefits of assets from their potential to generate cash inflows, especially when the assets are held by the entity for their service potential. In addition, several new OS paragraphs are proposed to provide not-for-profit specific commentary against content that was either not in the existing not-for-profit conceptual framework or is now considered useful to address the overall for-profit versus not-for-profit balance of the pronouncement. The basis for conclusions provides the purpose and rationale for each proposed OS paragraph. The AASB would like to invite feedback on these paragraphs and whether you agree with their insertion or otherwise. An example of the board's considerations of the not-for-profit amendments to the conceptual framework was the emphasis given to accountability or stewardship and the completeness and appropriateness of the parties identified as being users of not-for-profit financial statements. The board, on reflection, has decided that no significant change to these aspects of the conceptual framework is necessary beyond the limited amendments proposed. While changes or repositioning of these aspects in a conceptual framework could affect the board's decision-making on its future projects or on Tier 3 standard, part of the board reasons for its view is that the developments in sustainability reporting and its current project on service project reporting may advance thinking in these areas. Therefore, the board is not seeking and does not intend to address feedback on, for example, the accountability consideration as part of finalizing the proposals in this exposure draft, unless stakeholders provide feedback that the proposed treatment is so inappropriate that it would render the pronouncement unfit for use by not-for-profit entities. In our final few minutes, we wanted to share our outreach plans and explain how you can provide feedback on the proposals in these two exposure drafts. We encourage all not-for-profit stakeholders to get involved by either submitting a comment letter on our website or completing an online survey or attending a virtual or in-person outreach event. The details of these sessions will be made available on our website when finalized. There will be one session in December and several more between late January and end of February next calendar year. If you want to discuss any or all proposals in these exposure drafts, also please feel free to reach out to us directly to arrange a meeting. Your engagement is important to us, as your feedback will inform the board redeliberations on the exposure drafts and will help to deliver high quality standards that are fit for purpose. The online service to submit the feedback can also be accessed via the QR links shown on this slide. Just a brief comment about the ED335 survey. You can choose whether to respond only to the questions regarding the approach to developing the Tier 3 reporting requirements and major simplifications, which is a short survey of first 8 questions, or to respond also to the questions regarding the specific proposals of the Tier 3 reporting requirements, being the rest of the survey. Of course, the board's future discussions will be more fulsome the more feedback you can give us. Also, we recognize that some stakeholders might not want to comment on ED334 beyond its proposals that affect the not-for-profit financial reporting framework. So, we have included the relevant questions from the Exposure Draft 334 into the Exposure Draft 335 survey. Because the webcast cannot cover everything in the exposure drafts, we also want to let you know what other resources are available to you on our website. Those are listed on this slide. We want to encourage everyone to read the exposure drafts, as it is important for us to know that a draft standard is understandable and usable and says what it's meant to require. To support the consultation on these exposure drafts, the WSB has published a summary of the Tier 3 exposure draft proposals and the extent of simplifications compared to Tier 2 reporting requirements, and a key facts document that provides a high-level overview of the exposure drafts. The QR code on this slide will take you to the Not-for-Profit Financial Reporting Framework landing page on our website. In closing, thank you for your time with us today. We hope the webcast was useful to inform your thinking about the proposals. If you have any questions or want to provide us with the feedback, please contact Maggie using the contact details on this slide. Have a great day.